What's your progress on your course?
Yeah, it's launched, man.
Like, yeah.
It's launched.
I wonder how many like subscribers do you have, if you can share. Interesting.
Yeah, so I'm part of like the Ivan Tech Academy. So we have like around 250,000 subs on YouTube, and I think an academy is around 30,000. So it's pretty big in the crypto community. So definitely I will like retweet, and also when you guys go live, it would be very interesting to see the market pumping up. It's actually very interesting what you have built. So I also see, I want to ask actually in this session, I see there is a risk market and liquidation markets. Liquidation markets I understand. Risk markets. Can you explain a little bit about that?
Sure, definitely. A quick overview about our company, that would be actually the answer. So basically, Atomica, it's a risk transfer protocol, and our key expertise and our key products are around risk mitigation and risk transfer. So basically, anyone can like launch a new risk market, like against smart contracts hacks, bugs of Compound, Uniswap, Molokda, whatever, and buy a coverage against it. And accordingly, a liquidity provider can supply some assets to create this exposure pool, and to receive premiums, and to cover losses if there are any. This is our main product. We are already live on testnet, but few months ago, when when there was a Black Thursday event at MakerDAO, we did this liquidation market side product, because our architecture of pools allows to build it. So we switched to this product, and yeah, and pretty soon we will get back to our main product, and yeah. So that's pretty the answer.
And then this is your full-time focus, right? So this is your full-time focus at your company, and you also work for other companies, or this is like the main thing that you're doing?
Yeah, this is the main thing. Our company, like I guess almost 100% focused on liquidation markets, but also we're like working on like go-to-market strategies for risk markets, and yeah, and pretty soon we'll get back to this product. And maybe you've heard of the risk project. So basically, most of our team worked on it. Here is Renat. He's our founder of Atomica and as a risk as well. So yeah.
Or not? I think I saw some of your articles sometimes. You also worked for Ether Risk, right? Oh. But you all worked on Ether Risk, is that correct?
Yeah, I guess maybe he's muted, or maybe he's away from keyboard. Yeah.
Yeah. I was muted. I didn't realize. Yes, correct. I was one of the founding members of Risk. Joined the hackathon project in 2015, and
Nice.
when we had the team made out of Christoph, Stefan, and on this hackathon joined myself, Jake Brookman from Coin Fund, and Ron Bernstein from Paradex, which was an early 0x relayer sold to Coinbase. So it kind of allowed me to learn a great deal about the limitations of on-chain risk transfer, and Now the ETHRISK project is in the state of hibernation. There is no funds for continuous development, but basically the foundation is now a holder of IP assets that were created as a result, and it helps implementing the software to other teams who are interested in risk transfer. I'm still on the board of the council board of the foundation in Switzerland, but we don't have active operations going on. All of us are working on projects, basically applying the framework that we have built. And Atomica early version was built on top of generic insurance framework. Now we kind of pivoted to a custom new implementation. Effectively, it's a fork, but main concepts are the same, such as pooling risk, pool tokens, various levels of the risk tower, and now our focus is primarily only risks native to the crypto economy, specifically risks that are associated with money markets, and specifically the risk of solvency of money markets and solvency of individual pools and the individual positions of the liquidity providers, be it individuals like compound type, right, or Aave, or be it the
That is super interesting. I think the connection broke maybe.
Yes, and what is your interest in Atomica, and how did you learn about it?
Yeah, so I was giving a course on decentralized finance, and also about ETHRISK. I didn't know it was connected, but I saw the project also before. I'm a fundamental analyst in the crypto space, and I also I'm a software developer and investor, and I saw an educator. I saw the project. I'm working together with Ivan on tech, and I was doing research into like DeFi and of course Black Thursday, and then I found Atomica, which I think is a very good sound from the community towards. I hear a bit of
not you. Yeah.
Oh.
Yeah.
So I did a course on
Yes.
DeFi, and I found Atomica, and I actually also mentioned and showed you guys in the course a little bit.
Yeah. Thank you for that. We got some traffic from your cars to our website, so thank you.
Oh, you saw the traffic? Nice.
Yes.
Amazing. That's pretty cool. Yeah, you guys are doing a good job. I think with everything going on right now, it's a really good time to create these kind of risk markets, and also to see if we can create any products on top of that. But I think the liquidation market that you guys built is like a key piece for the community as well, because it's like highly needed. So I hope it goes live soon. Else, if there's another crypto crash, that's like DeFi crash coming for sure, the liquidations again will be crazy. I wonder, how do you do that with gas costs? Like for the Atomica, do you have a solution for that?
Yeah, I can answer that. Currently, we cover all the gas costs ourselves.
Wow.
Yeah, and pool gets pure returns right now, so we don't charge any fee. We don't have any business model for this right now. But in future, so basically we launched by ourselves this pool, and we will launch few markets shortly by ourselves. But we have planned. So right now we are working on a pool manager feature, which means that anyone can launch their own liquidation market. which is, if the analogy is to create token set as social trader, to set some custom fees if you want, and to perform liquidations with your own strategy, and you can realize and implement your own proprietary software or some knowledge about specific collaterals, chain collaterals, which are coming to MakerDAO and other money markets protocols. So, and that would be their job to cover these expenses. So yes.
And one question: what is your current stats on the audience, and what's your goal for the next year or two? What do you anticipate from the project that you are building, right? Could you give some desired numbers? Let's say a year from now, what would you like to accomplish?
Okay, yeah. So I'm also doing. I'm right now doing a lot of different projects. So I have a lot of things going on. So I have a couple of projects, but mostly I focus on the Ivan Attack Academy. I do courses there. So we're hoping to do another course in DeFi, or what I really want to do in the blockchain space is maybe create a decentralized financial like safe investment basket. And what I really want to achieve is that I pull more people from a centralized financial system to a more decentralized financial system.
Mm-hmm.
And I hope to do that by offering them safe alternatives to our current saving accounts or banking interactions.
I see. And what is the split of your time? Which projects do you spend, and how much, like percentage-wise? 50% on this and 50 on that, or it's what's your kind of focus split?
Yeah, so right now I'm also a software developer, right? So I'm hired right now as a consultant for a couple of companies,
Mm-hmm.
where I'm actually basically doing we're doing a GraphQL, React, Laravel, Golang.
Mm-hmm.
So I'm overseeing those projects, and I hope to finish them probably within 2 weeks. And then I want to go full focus in the DeFi market.
Mm-hmm.
That's basically, I just have to finish those two platforms. Yeah, and then I want to build a product that will be able to onboard more people into DeFi. I really see it as an important mission of myself to try to accomplish, and that's also why I gave the course with Ivan. He has 250 subscribers and 35,000 like email contacts that are really all interested in DeFi and crypto.
Okay.
And mostly new people.
And this product, when you talk about product that helps onboard people, are you referring more about the continuation expansion of your educational platform with some capabilities expanded on that, or are you referring more about launching a product that actually helps people use DeFi in a direct way, like more like Zerion or Linen, like which one? What's your
to be
definition?
honest, so right now, and I'm also in crypto for some time now, and I never was interested in the ICO boom. I was then a researcher, so I was researching the market. I see the market maturing now, so I'm actually still looking for one thing to really bite into.
I see.
Yeah.
I see. Well, then I can share my thoughts what might Atomica help you with moving towards that goal. How exactly? Number one that I was thinking about when Vadim mentioned we've seen some traffic, right? I was thinking like, wouldn't it be nice to get a portion of the incentives that these users generate, right, to be attributed to those who create value, right? So basically you earn a fair share of value you create, right? Not just the course itself, but if you make people use something and they benefit, right? And if some people benefit, it would be nice to have a portion of that value created to be shared in a more equitable way, right? So that, what does it mean? That means that for example, have you seen future swap? Yeah, future swap is non-custodial BitMEX. And they launched with early alpha about a month and a half ago for about a week. Now they're preparing the mainnet, like main release, right? It was on mainnet, and they have 3 forms of incentives. The first incentive, basically it's incentive in their native FST token that is given to 3 types of, in exchange for providing 3 types of value. Number 1, those who trade, right? They generate FST tokens. Number 2, those who provide liquidity, Ether and DAI, right? So that leveraged short long positions on Ether could be taken, right? Those receive FST token rewards according to their pro rata share of the contributed ETH and DAI. And the third type of incentive, the third category of recipients are those who refer users, the first kind, and the second kind to the platform, right? And these referral rewards are also denominated in FST token, right? And it's a pro rata share of how much liquidity or how much trading do the individuals who came into were onboarded on the future swap, right? How much they generate if you accounted for 80% of those who were referred, right? You get 80% of all the referrer rewards. Basically, let's say 10 people came from your website, right? I'm sorry, 8 people came from your website and 2 people came from someone else's website, right? With the referral link. And all of them traded and contributed capital equally. That means that your Ethereum account receives 80% of the referral rewards, right? So that's kind of what we don't have it now in Atomica, and probably won't have it in the next few weeks or couple of months. We don't even have a token, but it's certainly something we're looking at. And the simplest way probably would be for those basically allocate, once we have the pool manager functionality that Vadim mentioned, right? We could allocate a portion of the basically interest money earned to those who refer. So that's one idea. The second idea or opportunity may be if you still haven't picked the project that you're gonna spend some months, years working on. Yes. There are a couple of opportunities that are out there where you can leverage the Atomica markets to build a differentiated DeFi product. For example, would be, I will give you a couple of examples. One will be effectively a set, trading set, right? Where effectively you have an investment product where you manage a number of assets and rebalance them based on the market situation, right? And it may look like a set with fees, right? Or it may look like at the more granular level, imagine a pool. Like right now we have Maker 1 pool, right? If you are capable of, for example, developing a gas price oracle and hedge the gas at most, right? But at least the gas price oracle. You can create a pool, just like Maker One, right? But it will be your pool, where depending on how well you can see the gas, predict the gas or hedge it, how well you can monitor mempool, right? If you can monitor gas, why not monitoring mempool? And this is a source of competitive advantage for a pool that has it. Maker One doesn't have it. It's very simple, but it's an opportunity for a pool manager to add these things and accept funds from those who don't want to do it themselves, right? So basically, becoming a pool manager is a way to have a product which will be distributed by Atomica and all the interfaces, right? But most interestingly is that you can build a product on top of it, which may be consumer facing. Consumer facing meaning that it will be, imagine there is a Gnosis Safe, for example, right?
Yes.
They have launched apps. You can have an app that allows to deploy assets to generate yield from uncorrelated asset classes, right? Meaning that it will pick some of the basically allocate to your pool, and then during the peacetime when no action's happening, right, you will rebalance into compound, and what you offer is a unique asset class that when the price goes up, the assets contributed there. It could be any asset, right? Whatever Gnosis Safe supports, it grows with the market. But when the price of the assets goes down, right, it also grows because then there are liquidations, right? So that is a unique asset. And depending how you look at it, you can either make it completely non-custodial or you can make a basically an investment product like a fund, right, or both.
It's basically how Uniswap works, right? With the Uniswap pools, what you're explaining, right? Like.
Yeah, it's like Uniswap. It's like a social set, right?
What I got actually contacted by a company in New York, and they wanted to do homeowner insurances of the United States markets on the blockchain, right? I basically have a lot of different projects contact me to work with them or work on their project, but of course, I help them with the software setup and everything like that. But I'm still looking for my own deep dive project. Yeah, that's correct. I'm looking at a couple of projects, and I think Atomica can be actually one of the Lego blocks in DeFi where I create if I have an escrow, for example, or I have a home insurance policy that I need to make for something, I can use Atomica to secure these contracts and secure the assets that's backed by the contracts, right?
Yes, so that is, so we have at Atomica, we have two types of markets. They all transfer risk, right? But they're different, so we separated them not to confuse the liquidity provider. The first type is the liquidation markets, the ones that you see now. The second type are the pure risk transfer markets, meaning where in the liquidation markets, you take the risk, right? What kind of risk? Risk that markets, the collaterals will not be liquidated, right? Basically, the price goes up and the opportunity cost, right? So you need to be smart about managing your funds, assets, right? In the peacetime, right? So that it generates yield and so on. But there is no one is paying the premium specifically, right? However, we have already interested parties to compensate, basically to pay incentives in the form of something like land token from Aave for those who contribute capital to the liquidation markets. The second type of markets is the risk market. That's where the premium is paid and the investors in the pools take the risk. What kind of risk? That let's say, contracts of this, for example, company or this protocol will be hacked and it won't be available for use, or contracts will be hacked and the funds are gone, right? So these are risks that could be transferred, and also there is a way to create a pool, create a market, right? Similar to liquidation markets, the pool manager, right? It just, there is a curve, a price that determines how much yield you get, and you get yield all the time, right? Not just when markets go up, right? You get paid yield the next block after you took the risk.
Yeah, that's very interesting. I have thought like that's very, and I think that it's very useful. Like, and I followed Ether risk, and also Atomica. I also did a deep dive in the convexity protocol and to Opyn. What I don't understand yet, or Nexus Mutual, what I don't understand yet, like if you look at the current insurance market overall, like AXA or all these other insurance markets, they don't look at blockchain yet. But why is there not yet one of these bigger insurance policies that uses these technologies and is actually overtaking the market because of the lower operational costs?
The reason why is because the capital that is backing the, let's say, homeowners insurance, right? Property, casualty type of insurance, there is so much of it and it's so cheap.
Okay.
And because the amounts necessary are so large, right? We're not talking thousands, right? In order for
50 million. The
yeah,
homeowner
exactly.
insurance was
So
like 50 million to get started.
50 million worth of capital, right? Whether you have $5,000 of cost to $25,000 of cost is not going to make any difference. So because of these reasons, these markets have not moved on chain, right? And one of the primary reasons is that historically it takes 2 to 3 years on average to create a new insurance product. It's a very long time, a very tedious process. And the bottleneck is not in getting reinsurance capital, someone to take risk. It's not a problem. Why is it's not a problem? Because everyone is looking for yield, right? Interest rates are very low. Anything that yields, 5–10% and has a probability of loss of 1%, right? Like 1 in a 100-year event, all the houses go burned down, right?
Yeah.
The spread of plus the spread, and now with the interest rates are 0.25, for example, right? 1% probability of loss, add the cost of capital, right, which is the risk-free rate, right? The 0.25. If it yields 7%, right? Now you have a spread of 5.5 risk-free yield. There is plenty of people who are willing to put their capital, allocate a portion of their assets to this asset class, right? And there is no shortage of capital. What's the problem? The shortage is of premium, right? You need to find the premium, you need to get people to pay it, right? And that is where the bottleneck is. And not only it takes a long time to create a new product, and basically launching a new product, majority of time is not about finding capital or insurance or license. These are available commodity. You can rent the license for 5–7% fronting fee. All United States, you get an insurance license. For 7%, there are not one, but like 10 companies that sell such service, right? Insurance license for rent. But what they require is premiums. They ask, how much premiums do we have, right? Well, we're just a startup. Well, go, fine, we can give you a license, but what their quote is, absolutely, we'll give you a license, $500,000 per year is the cost of the license, minimum, and it's basically 7%. So what it means is that you can sell $8 million worth of premiums, right? Now you have basically a startup cost of $500,000, right? And the most people struggle with getting people to pay the premium. Because if you have the premium, there is no problem with capital, with licenses, and so on. So this kind of like a chicken and egg problem. And what DeFi risk markets offer is ability to create new products and start validating them without licenses, because it's a non-custodial. There is no risk an agent running away with the money, right? There is no risk that money in the pool will be taken by the pool creator. So
and no government can stop it. Well, governments can be annoying,
they can stop it, but the question is then, what can they ask you to do, right? They ask, hey, it's insurance, okay? So what's the risk? Consumers are in danger. Okay, what should I do? Well, stop operating. Okay, I'm gonna stop operating, but it's not gonna prevent people from, because if they say, can you just unwind the operation? I don't have access. I cannot take money from this. So from this pool, right? I cannot people prevent using the blockchain. They ask, well, but it's an insurance, right? Do you have a license? License for what? To sell insurance. Well, okay, why do I need the license? Well, because you can run away with the money. I cannot run away with the money. So there is nothing to regulate me, because the very reason the regulation exists is to prevent people running away with the money. And if you cannot run away with the money, you cannot even do anything with the money, right? What do you want us to do? We can stop working on this project, fine. That's what we can do. But you cannot prevent people from using what's on chain, right? So
I really like the philosophy when EtherRisk got started, and I actually watched an old interview. I think somebody from EtherRisk or an article that it says like he create insurances that create themselves and manage themselves, basically, right?
Yeah. It's basically a contract between people who put money together, right? But I'm not against like regulation, right? I'm fully for it, and I have used, I launched the fly delay insurance while at EtherRisk. It was the first fully regulated insurance product that was sold by a smart contract. And because we had custody of the pool, we could take money away, we wanted to regulate it, and we got the license in Malta so that we can sell worldwide, right? And we were the administrator of the contract, right? We could do anything we want with the funds that are remaining. We were earning basically a fee, 5%, right, to pay for gas, right? So that's it was fully regulated. We learned a great deal. But the opportunity here is that if you're looking for candidates for a product, this is one of these risk types. These are kind of they're not the hottest out there, not the largest by volume. But they're kind of like I would consider it a safe bet, right? It always follows the big success stories on DeFi, because in order for them to grow, they need to grow amount of capital locked, right? Number of collaterals they support, speaking of money markets. And that means the amount of risk is increasing. Risk what kind? Like collateral not going to be sold fast enough at good enough price. There is no collateral. What if it was seized by the government, like these off-chain assets, right? What if there is a price drop so big where basically the system, the pool becomes insolvent, right? Basically, the amount of debt is higher than what the assets are worth, right? So all of these risks are growing, and the opportunity to create risk pools, manage them, right, and make them available for people who want to back them is the opportunity at hand. So it's a role of a pool manager. If you're interested in being on a list of those who will try it out among the first, we could show you and see if it's something that you want to explore. We would love to support you.
Yeah, with the MakerDAO pools, right? Yeah, I would definitely be interested to send some assets your way. I was one of the people that got a little bit. Luckily, I almost liquidated all my vaults. One vault got killed by the evil. Well, it's not a hacker. It's just somebody that was smarter than the other keepers, right? So yeah. What can you say? It's okay. It's not that much. So it's I would be interested in definitely testing out the liquidation market and also the risk market to see what we can we can do there for sure. Yeah.
Well, okay, Vadim, please take over from now. We already spent a lot of time here, but It was very nice
Yeah.
to do.
Thanks. Yeah, I hope to see more insurances on chain. I still don't understand why we don't see technology like destroying all these old legacy systems just yet, because it's very inefficient. I worked for insurance companies before, like 6 years ago, and it was not nice. Very boring work, very old systems. I don't understand why they're still they're still making too much money. I guess that's the answer. Right?
Well, it's because it's I answered the question. It takes a long time to find someone paying the premium in amounts big enough, right? And once you have it, it's very kind of once you put the rails, it's working, and the switching costs are high because you have distribution, you have capital, you have these rails in the middle, right? A bunch of people involved. You can replace one, but you cannot replace. You can replace one middleman out of 7, right? But replacing all 7 middlemen is very hard, right? Because they all have their own interfaces, customer base, right, and so on. So what we're creating are end-to-end markets where consumers paying premium. It goes into a pool and people earn it as a yield, right, on the other side. With a very few middlemen like pool manager.
Well, one last question. How does the Atomica differ from Opium or from Nexus Mutual? Okay,
good question. I can maybe show you, we have a table, but to summarize, with Opium, Opyn, not Opium. Opyn is also a market for risk transfer. Risk can be, there are 3 things you can do with risk. You can retain it, you can mitigate, you can transfer it, right? So when it comes to transferring risk, there are several ways you can transfer. One way is to is insurance. Another way, for some assets, there are derivatives, right? Like options. So, unlike Opyn, Atomica risk markets, not liquidation markets, but well, actually, unlike Opyn, both liquidation markets and risk markets at Atomica can take any kind of risk, even if there is no token with liquidity attached to it, right? You can basically sell Ether or CDAI, right? But how can you sell a risk of Gnosis Safe being hacked, right? There is no token for your Gnosis Safe wallet, right? You cannot buy an option on it because there is no market, there is no even token, because if you have a token, you can have a market, but even if you have a market, it doesn't mean it's liquid, because what's in your bag? In your bag could be a bunch of NFTs, right? How can you sell it? You cannot have a real good option market on such small volume, very granular thing, right? Who would buy and sell an option for an NFT? Right, you need to put NFT into ERC20, and this ERC20 represents the price of NFC, right? It's all can be done, but at some point it's kind of the one difference. The second difference is the capital efficiency. In Opyn, for every asset, you basically need to lock the full amount of money at risk, right? So that you can settle the options upon maturity, right? Yeah. So when you have the right to buy or sell at a future date, right? It means that at a future date, the assets must be there locked, all of it, right? Enough to give you the asset at a good price, right?
Yeah. So basically, you're creating a synthetic, right? Synthetic of the risk. Synthetic.
Yeah. So what this means is that for more than 100% of all of your risk, you must have capital on chain, right? What it means is that in order to protect, let's say, $100 million worth of risk, right, exposure, you need to have $100 million in there. Mm-hmm. With risk markets, you don't have to have $100 million because if you have 20 different contracts that you're insuring, right, the probability of all of them being hacked in the same year is still not zero, but it's so low that consumers willing to accept the fact that if my contract I'm using it was hacked, if I'm number 10, right, this year, then I'm not gonna get paid. That's okay risk that people willing there. Basically, if I'm within the first 10 to be hacked, then I get compensated, right? But then you add another different contracts, right? Someone will be hacked, someone will not. So altogether, basically, collateralization ratio does not have to be always above 100%. Insurance companies, for example, in the European Union, they have a 99.5 solvency. Basically, they don't have money to pay everybody. Solvency 2 requires you to have enough money to pay for events that are likely estimated to be one in a 200-year event or more frequently. If it's a 1 in a 300-year event, you don't have to have capital for all of it, right? For big catastrophes, right? And in some other countries, it's even less, right? In some countries, insurance actually regulated, you have to have enough capital to be at least 5x of your premiums. That's how some insurance regulate in some countries, right? So basically, it's very under-collateralized, and it means that it's cheaper to buy, and there is a risk, of course, of insolvency, but it's once you have a big enough portfolio, it's spread and managed, right? So these are the differences, the two differences in with Opyn, the differences with Nexus. Obviously, they have capital efficiency, right? They don't have money to cover all of it, right? Just like Atomica. But the difference is that Atomica is building a generic risk market, meaning like Uniswap. You can come in and create your new market where your own, for example, DeFi education course, right? You will be covered by against liability risks. If someone loses money and they say, "Oh, that's this dude. He told me to go in there to Atomica. I went there and I lost money." Right? You want to get this liability insurance, right? You go and you create. You go to Atomica risk market. You click a button, create a pool, right?
Yes.
And then the users who want to basically have some recourse, if I'm using your education tool, right? You're sending me, put money here, try this, try that, right? Now you offer insurance that they could buy, right? Against the loss. And that's another risk pool. But the first risk pool is that it's basically I'm willing to pay a little bit of my earnings, right, to transfer the risk of liability. So you pay, let's say, 1,000 DAI, but you will be covered up to 50,000 DAI, right? Basically pay 2%. And you will get paid up to 50 in case you get a lawsuit where they say, I lost my life savings of $10,000, right? In case court says, yeah, Amadeo must pay, he's liable. Right.
And then the money gets, who's releasing the money then? Is there like validators in the
Aragon court. Aragon court basically will have to vote whether Amadeo was sued and whether the judge said he's guilty and must pay. Then up to $50,000, whichever is less, meaning that if the court says Amadeo must pay 20, the pool will pay 20.
Nice. Yeah, that's very interesting. Then basically for everything,
the difference with Nexus. Yeah, is that Amadeo can create a market, right, and basically get other people to take the risk of Amadeo being sued for liability of someone losing their life savings.
And they get an interest over the years that it's still in the market.
Well, you pay them 1,000 DAI, right? That's the premium, and they're happy campers because they think it's well, now when the people lock this capital, right? It's not the only risk they take, right? They take others. And they don't have to take all of it. They only take the first 5,000 and someone takes another upper limit. Basically, these are their insurance pools, right? And for them, why would someone want to earn, for example, 10% or 5% yield, right? By locking so much money? Because for them, it's uncorrelated risk. Ether can go down in price, but the events like Amadeo getting sued, right? It doesn't happen on the same schedule, like S&P or the price of Ether, right? It happens on its own schedule, right? Also a bit related, right? But it's uncorrelated asset class that keeps on yielding. Ether goes down, this asset keeps on yielding. And that's why they allocate a little bit. They never allocate all of their money to this to take a risk, right? No, they allocate 0.5%.
Yes. That makes a lot of sense. That's pretty cool. So it's basically, Atomica is basically also a layer on top of Aragon and on top of different markets, because of course the liquidation markets are separate from that. Okay,
so
cool.
I was talking about the risk markets. Liquidation markets, the risk is defined, right? It's a risk of collateral not being there, not being liquidated fast enough, right? And the premium is the earnings that you will have as a liquidator, right? And the downside is that there will be no yield, no liquidations, and so on.
Nice. Yeah, man, super interesting. I will definitely, if also that project in New York comes through, then I will contact you guys also. I think that's interesting for them, because they definitely need to use something like this. Also, yeah, for other projects, I will definitely keep it in mind. And when you guys, are you already on mainnet with the liquidation markets? I saw.
Yes. Yes, with liquidation markets, we launched a few weeks ago. So yeah, we are already on the net, and I sent you the access before the call. So definitely try this out. It would be great to hear your feedback. Yeah, we did. You provided already your feedback for when we were on testnet. So yeah, and thank you for this. But maybe if you have any other comments, suggestions, it would be great to hear from you. So
yeah, I will send
check it out.
I'll send some DAI, and I'll start playing around with it. Would be very interesting. All right, guys, cool, nice. That was thank you for that. It's super amazing to get all this attention. I feel very privileged to have the honor to talk to Renat and to you guys. It's cool that you guys are building. Yeah, I have to go now. Like the balance token just launched. There's a lot of things happening again in the market.
Yeah, just launched. So yield farmers are preparing their weapons to farm.
Yeah, it's a bit dangerous. I stay away a little bit. I just use on Curve, the liquidity pools are interesting, but also Curve, I feel, is also dangerous. But, yeah.
Well, you have clearly understand your risk when you're using Curve. It's a great product, but yeah, you have to have a large capital because of fees, and also there's a impairment loss. Sure, it's minimized comparing to Uniswap, but still, yes, there are risks.
Yeah, definitely. Yeah, that's I think the interesting is maybe like a Curve insurance market, Curve risk market, maybe. Be interesting. Okay.
Yeah, we'll definitely study this opportunity as well.
Yeah, there's nobody on the. I guess the bigger capital is more on Curve, because the people that don't. It's more like, as you said, like higher, because it's like the gas fees are really high. You're not going to go there with $100 or $1,000. You go there with, I think, more than $2,000, more than $5,000. Yeah, definitely. I will look into that, and then let me know when everything launched, when the other risk markets
Definitely.
are launched. Then
Definitely.
I'll keep following you guys. All right, man. Cool.
Okay.
I'm gonna get some food.
Okay.
Take care. Thank you, guys.
Bye.